And hello, my colleagues. And I do hope everyone is well on this beautiful weekend we're having here, and everyone is safe and sound. And what I'd like to do is we're going to talk about Chapter 6 now. We're going to introduce Chapter 6, which is bonds, interest rates, and how bonds are calculated. While I sip my coffee a little bit. It's very early in the morning. And before we start, I'd like to do a snippet on from your book because I think they're actually quite excellent.
When firms need to raise money from investors, they have two ways to do that. They can issue equity by selling common or preferred stock, or they can borrow the money they need by taking on debt. Firms can borrow money directly from financial institutions like commercial banks, or they can borrow from a more diverse group of lenders by issuing securities called bonds. Bonds are the focus of this chapter. There are really two main ideas in the chapter. The first idea centers on the return that investors demand when they purchase bonds, and therefore the interest rate that firms must pay when they issue bonds. When investors buy bonds, they do so in the hope of earning a return that increases their purchasing power over time. An investor's purchasing power will increase only if the return that they earn exceeds the rate of inflation. So, one of the main factors that influences interest rates is inflation. Generally speaking, the higher the rate of inflation, the higher the interest rate that firms must pay on their bonds. Another big factor that influences interest rates on bonds is risk. From the beginning of this text, we've said that there's a trade-off between risk and return. Investors demand higher returns on riskier investments, so when a firm issues a bond, the interest rate that it will have to pay will depend not only on the rate of inflation in the economy, but also on the riskiness of the firm's bonds as perceived by investors. A bond's risk depends on characteristics of the firm that issues the bond and on the attributes of the bond itself. For example, a firm that has very little debt on its balance sheet and generates reliably positive cash flows will have to pay a lower interest rate on its bonds than a firm that has a lot of outstanding debt and produces more variable cash flows. Likewise, other things being equal, long-term bonds and bonds that are not secured by any form of collateral are more risky than short-term bonds that are backed by collateral, so interest rates on long-term bonds and unsecured bonds are generally higher. The second main idea in this chapter is that you can apply the time value of money techniques you've already learned to estimate the price or the value of a bond. A bond's value is just the present value of the cash flows that it promises to make over its life. When you calculate a bond's value, you simply discount its future cash payments using the return that investors require on the bond as a discount rate. But remember that higher discount rates lead to lower present values, and lower discount rates lead to higher present values. That means that as the required return that investors demand on a bond changes, either because inflation is changing or because the risk premium that investors require is changing, the bond's price will change too. Specifically, a bond's price moves in the opposite direction of its required return. If inflation increases, or if investors demand a higher return as compensation for risk, a bond's required return will rise and its price will fall. Just the opposite happens if required returns on bonds decline. Bond prices rise when the required returns fall. The possibility that a bond's price will move as interest rates change in the market is the primary risk of investing in many types of bonds, and that risk is called interest rate risk. As you read through this chapter, you'll learn that some bonds have greater exposure to interest rate risk than other bonds do. Lots of big companies issue bonds periodically, and at some point during their lifetimes, nearly all investors own bonds as part of their investment portfolios. So the information in this chapter may help you become a better financial manager, but it can certainly help you become a better investor.
So I just wanted to go through that snippet with you there. Okay. So let's kind of go through these some of these items here. And the first thing you got to know is we have to understand how interest rates behave in the economy. And interest rates are a very dynamic thing. They change all the time. And how they're going to affect the price of funds, such as bonds, and the cost of bonds, as you see here, This is all very, very, they're all tied together, as you heard in that video. And we got to see how basically how interest rate levels and the company's ability to issue bonds may affect the availability of financing for marketing and research projects. It's important to understand if companies don't have good risk, operational risk or business risk, they're going to have to pay higher interest for their bonds, okay, because people are taking more risk. If you take more risk, you want more return. That's a famous saying in finance and one that you should always be aware of. Higher risk means higher return. And you can see here how the interest rate level may affect the firm's ability to raise funds to maintain and grow the firm's production capacity. And we're going to talk about in your personal life here. Again, personal finance, how bonds, how interest rates affect you, and most likely with regard to mortgages and credit cards, maybe, and car loans, I assume too, right? You don't want to pay high interest rates, right? Okay, so there's an interesting thing here that's worth reading about the Aston Martin bond issue. The company issued bonds. This was the company that made the Aston Martin that made the James Bond 007 car. And so it's worth reading that, okay? And you can go through that. All right. So the interest rate, and there's two words here that come up, right? The interest rate or required return. So those go hand in hand. They're common words, right? Represents the cost of money, right? So that's what you're going to pay for money. All right. It is the compensation that a supplier of funds expects and a demander of funds must pay. Usually the term interest rate, and let's click on that if you don't mind, usually applied to debt instruments such as bank loans or bonds. The compensation paid by the borrower of funds to the lender from the borrower's point of view, the cost of borrowing funds. Okay? And over here, required return. So they have slightly different meanings, but they're used interchangeably, okay? Usually apply to equity instruments such as common stock. So the cost of funds obtained by selling an ownership interest. Even though they're used used interchangeably, there is a meaning that they're specific meaning to them. But you can see what it says here. The meanings of these two terms are quite similar. Because in both cases, the supplier is compensated for providing funds to the demander. Okay, so basically, so this is interest rates, okay? And so looking at historical data to measure the actual returns that the different types of investments have provided helps managers and investors form better judgments about the expected returns. Okay, so you're going to look back in the past to and it's not always good. Actually, you don't have a crystal ball, right? To see what you can expect in the future from an expected return point of view. So expected returns are what we judge everything on, and those weigh more heavily than actual returns. And this is an important point. So interest rates, like everything else, have what's known as supply and demand, right? The price is determined by supply and demand, just the way the prices of things we saw during the pandemic went up on, Lysol, whatever, hand wipes, and the demand was high, so the price shot up. So here you can basically see the infamous supply-demand curve, okay? And basically, here's interest rates, okay? And so here's the demand curve, and here's the supply curve. And you'll notice here that the if the demand goes down, basically because right, and here's the supply. So where they intersect here is, you can see interest rates have dropped, okay, from R0 to R1. So the supply curve rides up and down the demand curve, okay? So let's click on that. And you see that there. And then let's see what they say. Let's go through that because that's interesting. So there's this equilibrium point that occurs, and as the supply and demand curves move, as the supply curve moves along the demand curve, economic forces will alter the interest rates. Okay? And you can see here it says the result would be a lower equilibrium interest rate here. And how do interest rates change? The equilibrium point, and the most important term is your worst enemy, inflation. Inflation is your worst enemy when it comes to money. And let's click on that. Inflation is a rising trend in the prices of most goods and services. Okay. And basically, that's an important factor. And there's a couple different factors here which we have to, you should be aware of. And an interesting point is we always thought interest rates could be positive. And lately, interest rates went negative. That assumption was not true, that they would always be positive. They were turned upside down, as you can see here. And what does it mean when interest rates are negative? It means that if you take your money and put it in a safe harbor, that basically you've got to pay them to save your money. So look what it says here. Central banks in several European economies and in Japan instituted policies that resulted in negative interest rates. When a loan carries an interest rate below zero, the lender essentially pays interest to the borrower rather than the other way around. That's because people are trying to avoid riskier assets and would rather pay someone to harbor their money in a safe asset. And these were called back then in Europe and Japan negative interest rate policies to combat weaker economic growth. So the question actually would come up then, as I mentioned, is why would anyone buy an investment if it paid an interest rate below zero? The answer is that there is no good, safe alternative offering a better return. And you could kind of see what I'm saying here. You probably want to avoid equities because the market is dropping in equities. Consumers and other investors who do not have large amounts of money to invest could hold cash at home and earn a zero return. And indeed, signs of more cash hoarding materialized after the NERPs were put in place. Even so, holding cash is risky because cash can be stolen or lost in a fire. All right, so basically, that's kind of the way that goes. And here is an interesting fact that fears in the U.S. economy turned T-bill rates negative during the 2008 financial crisis, right? And this is worth reading because it's a good history. All right, so let's talk a little bit about nominal and real interest rates. And let's get the definition of the nominal rate of interest. And the nominal rate of interest is the actual rate of interest charged by the supplier of funds and paid by the demander. So when you get a loan, right, or you go to the bank to put your money in, this is the rate that the bank is going to give you or charge you. That's called the nominal rate. So you see the word actual here, right? So it's actual. So that's what you're actually going to see. So if you went in a bank today and said, how much is your interest or how much you charge me for a loan, they're going to give you the nominal rate. So those are nominal rates. So if you put $50 into an investment that promises to pay 3% at the end of the year, you will have $51.51. So your nominal rate is the 3%. So here is your nominal rate, okay? So everyone should be aware of that. That's your nominal rate. But this does not necessarily mean that you are better off at the end of the year, because the nominal rate doesn't take into account inflation. And this is the most important point. Inflation is a killer. You should always be aware of the inflation rate, which is why a lot of people invest in the stock market, because they want to avoid inflation. Now, the real rate of interest, let's talk about the real rate of interest. So this is the rate of return on an investment measured not in dollars, but in the increase in purchasing power that the investment provides. So this measures the rate of increase in purchasing power, okay? So that's important. So in the current example, the real rate is 0, even though the nominal rate is 3%, because inflation is probably banging away at 3%, okay? So you can see grocery prices rise by 3%, so your real rate is 0. You're not getting anything. So that's an important point, okay? All right, so I'm going to pick up, we're 16 minutes into this, I'm going to pick up here when we make the next video, okay? All righty, see everybody later. Be well.